Hey, good day, everyone. My name is Bert Salazar, and I'm going to be your host for this Saturday financial literacy program event. We had a little bit of a technical difficulty. We had some storms coming through about an hour and a half ago, so our system shut down completely. But it's Saturday morning, as you know. We all get together the second or the third Thursday of every single month. If you happen to be a member of our firm, you happen to be a client, obviously, not only do you have the ability to come to these financial literacy programs, but you also have the ability to have the recorded version of everything that we do from a business standpoint. So again, I'm excited to be here. Welcome. It's Saturday morning. It's obviously Valentine's week. My name is Bert Salazar, and I'm going to be your host, as I always am every single month. These are workshops and these are webinars that we do for all our clients and all the followers that we have on Facebook, on Twitter, on Instagram, on LinkedIn. And the key for us is we feel very strongly that information without education always leads to failure. So every second to third Saturday of every month, we try to compile information that we feel may be beneficial to you or would be beneficial to you and your family. Planning, your retirement distribution planning, your tax planning, and so forth. So this week, it's Valentine's week, and my wife of 34 years, my bride, and she still likes me, by the way, we were having dinner Wednesday night, and obviously we don't like to go out on Valentine's Day because it's kind of busy out there. You don't get the right service to the places that you would normally go to. So we went out on Wednesday night, and all of a sudden I get a message on my cell phone telling me that the national debt, had just hit 22 trillion for the first time in history. So, obviously I track the national debt and I track everything that has to do with economics because that's what I do for a living. I'm a retirement strategist. I am also a tax planner. So anytime that I put out either a video or a webinar or a seminar that we do on a monthly basis all throughout the state of Florida, primarily Dade and Broward County, our goal is to provide education. And obviously when the national debt hit 22 trillion, my wife said to me, honey, what do you think this means? How bad can it get? So I thought it would be important for me to take a few minutes of your time today, especially on a Saturday morning at 9 a.m. Eastern Standard Time, to be able to share with you something that is very critical for all of us to understand. And the sooner that you get to understand this, the better off you're going to be in your financial life and your financial decisions, not only now, but also in the future as well. So I felt compelled to do a short presentation on the principles of economics. Many years ago, obviously I have an economics and financial background. So, obviously my college years, I have an accounting background, and I've taken a lot of courses when it comes to economics and financing. And I have been in the financial services industry for almost 30 years. Actually, next year would be 30 years that I've been a retirement strategist here in Florida. But one of the major things that I wanted to share with you is that if you truly understand economic principles, then you're going to notice that things are going to change along the way. Products are going to change. The way you may want to do things may change, but the principles of economics never change. And one of the things that I always try to transfer from an informational standpoint to all my clients and all the listeners that we get on an ongoing basis is that methods are many and principles are few. Methods are always changing, but principles never do. So if you stay true to the principles of economics, and some of the things now, obviously, there are a number of principles that I can discuss with you today, but it would take us 3 hours to get through all of them. So I'm just picking a few that I feel would be very, very critical, for most of you on this call. So without any further ado, let me go ahead and let me share my screen with all of you so that way we can start on this presentation that we're going to be going through today. So hopefully now you should be able to see my screen. Again, principles of economics. Let me get a little bit of water. My name is Bert Salazar, and I'm going to be your host, as I always am every single month, for this financial literacy webcast and webinar that we're doing. Obviously, I'll tell you very quickly a little bit about myself, because it's not about me today. It is about you. I am a certified financial education instructor, and I'm very proud of that, because I am someone that truly believes that information without education always leads to failure. So if I have the ability to impart and bring education to each and every one of your lives, then I consider myself very lucky in that I have done the proper job. Now, for many, many years, obviously being in the industry, when I first started in the industry, your vision and your mission in any type of business changes over time. So in the very, very beginning of my career in financial services, my goal was to be all things to all people. And I probably did that for about 3 to 4 years. But then obviously you start to gravitate to something that you truly enjoy. And you start to gravitate to things that your clients and your listeners are asking for. So I went from trying to be all things to all people to being all things to some people. Now, obviously, that became a little bit more targeted, but it was not targeted enough. But although that was the case, I started to find myself from a business perspective as to what I truly wanted to represent to my clients and whereabouts. I wanted to position myself as a business owner in this incredible community that we live in. So that lasted about another 3 to 4 years. So when I hit the 10-year mark, and over the past 20 years, our goal and my vision has not been to being all things to all people, or even being all things to some people, but primarily to be some things to some people. And the way I like to decipher that is that because of the fact that we're targeted, and because of the fact that we specialize in retirement planning, and most important, tax-free retirement planning and retirement distribution planning, then it gives us the ability to truly create a vertical market penetration in which we can identify those individuals in our community and throughout the United States. I have clients all throughout the United States that are very, very critical in learning more and more about retirement distribution strategies and so forth. The other thing I got to share with you is that there's a difference when it comes to client engagement. We're very careful in the type of planning the type of clients that we engage, because of the type of work that we do for our clients. We're doing quarterly reviews with every one of our clients. We're doing semi-annual reviews, with some of our clients that may not have the time to do quarterly reviews. But every time we do one of those, we kind of walk our clients through our customized tax planning blueprint that I fill you in if you stay to the very end of this webinar. But at the end of the day, we're only looking for clients that are committed and not just involved. Now, you may say, well, Bert, what's truly the difference between being involved as opposed to being committed? So I would say, well, if you've ever had bacon and eggs for breakfast, the chicken was involved, but the pig was committed. So from that perspective, and I know that analogy is kind of funny to you, but from that perspective, we want to make certain that we're only engaging people that are committed to the retirement planning process, because this is a very interactive process that we use with our clients, because at the end of the day, we want to make certain that they can learn as much as they possibly can, whether we are there for them in the future or not. So obviously that's something very critical. Now, as far as the type of work that we do in our firm, and we own 3 firms, by the way. One firm is Camelot International Group, and that's our alternative investment firm. The other firm is Cambridge Financial Partners, LLC, and that is a firm that does all of the insurance planning, all of the pension planning, all of the long-term care planning that we do for other clients, and many of the clients that we engage. And then last but not least, we also own Gable's Tax Planning Group, which is the firm in which we do the vast majority of accounting services for our clients. I would argue that 70 to 75% of the clients that we engage for the first time come to us because they have some kind of a tax problem. So when you look at the industry, the financial services industry per se, you will find that you're going to have firms that do insurance planning only. Other firms do investment planning. Some do a combination of both. Some do insurance and investment planning, but very, very few firms in the United States have the ability to do tax planning, insurance planning, and alternative investments. And you have to have the proper background in order to be able to do tax planning. Now, not only do we have the ability to do the accounting from year to each and every one of our clients, but we also do tax planning services in which we have the ability to do tax forward planning and identify and work with our clients and how do we get them to minimize and or eliminate their taxes, not only now, but also in retirement. Now, there you're going to see a map of the U.S. tax history. And one of the things you're going to find very interesting as you see this map is if you look toward the left, you notice that in the very beginning of the tax code back in 1913, taxes were very, very low. And by the way, the red represents the highest marginal tax bracket in the history of the U.S. at that point in time. And then the second lowest marginal tax rate or tax bracket was, during that area of the Great Depression in which the government had no choice but to reduce taxes at that time. But if you start to move forward and you start moving to the right, you're going to notice that there was a point in time where the highest marginal tax rate in the United States was approximately 94%, and that was between 1944 and 1945. Now, you would wonder who would pay 94 to 95% in taxes back then, and obviously anyone that made over $200,000. Now, if you fast forward $200,000 of income, that was a lot of money back in 1944 and 1945. It would be equal to someone earning approximately $3 million today. And there was one actor in particular that later on became president of the United States, and I guess we all know who that is. That was President Ronald Reagan, who, if you read his biography, you would figure out that he would only do 2 movies a year. He would, work 6 months out of the year, do 2 movies. He would earn approximately $100,000 per movie, and then he would take the rest of the time off because of the fact that if he made more than 2 movies a year, then he would earn north of $200,000. And then obviously 94 cents out of every dollar the federal government was gonna take, and he wasn't even gonna get the other 6 cents. Now, I know it was not gonna be his ex-wife or anyone else. It was going to be the state of California because of their state income tax. So, he decided to work 6 months out of the year and take the rest of the year off. And then obviously he would go have fun, and then back in January of the following year, he would get back to doing movies. Now, if you look to the right, toward the very end, you would notice that we are now in the lowest historical tax rate in the history of our country. Now, this is what's interesting to note about our tax rate. If you take a look, we just hit $22 trillion for the first time in history in our national debt. By the way, we're almost at $1 trillion in deficit between the amount of revenues that the U.S. government brings in versus what we pay out. And that obviously, that's also caused by all the entitlements, once you give an entitlement, is very difficult to get it back. And by the way, this applies to both Republicans and Democrats. But what's even worse than the national debt and the entitlement program and the deficit, which is approaching $1 trillion in 2019, what's even more difficult than that is the unfunded liabilities that we have in our country today, which are at they're currently at 122 trillion. And unfunded liabilities are those promises that the U.S. government has made to all of us that they don't have the money to keep today. That would include Social Security, Medicare, Medicaid, Medicare Part D, and interest on the national debt. Now, one of the things that I share with the vast majority of clients and the vast majority of you that join us for our seminars and our podcast and our webinars on an ongoing basis is that you're going to be earning a fortune by the time that you retire. So if you look there, if you move to the last line, which is 35 years of earning income from the time that you start working. Now, most of us, have earnings of 40 to 45 years, but I'm just using your best, 35 years. If your income is $4,000 a month, you will see there that in 35 years, you would have earned, almost $1.7 million in revenues when it comes to the income that you have earned for 35 years. What if you're earning $8,000 a month when obviously you see there that it would be north of $3.3 million. And if you make, $10,000 a month, obviously you can see there is north of $4.2 million. Now, what does that tell you? Well, it tells you a couple of things. Number one, that all of us have the ability in this capitalist society that we live in to make as much money as we possibly can. By the same token, it's not so much about the money that you make, it's about the money that you keep. And the reason for that is that there are pretty much four monetary options that all of us need to be able to understand. Now, you can either spend your money, you can save your money, you can transfer your money. We'll spend a little bit of time discussing transfers of money, and then last but not least, you can give your money away. You can give it away to charity or whatever that may be. Now, the big question is, well, if these are the four things that we can do, with our money, who are the people and who are the institutions that want to have added to our money, that are there every single day trying to get to our money as quickly as they possibly can and as much as they possibly can. So we have three bodies of institutions that are always trying to get to our money. So we have the U.S. government, and that comes through all the taxes and fees and all the stuff that they're trying to bring upon us in order to take more and more of what we earn every single day. Then obviously you're going to have financial institutions that are going to try to get your money through fees and commissions and different programs that they want to make available to you. And then last but not least, because of the fact that we live in a spending society, we have large corporations that want to have access to our money on an everyday basis. Now, although we have to understand that these are the three major institutions that are always trying to get at our money, we also need to understand that we need these institutions in order to make it in life. The key thing is, if you understand what it is that they do, then you can provide and you can prepare for things that you're going to be able to do that I'll share with you in the next few minutes in order to minimize that exposure to the transfer of money that is so critical for the vast majority of us. Now, financial institutions, and I'm talking about all of them, especially the three that we have just discussed in the previous slide, they also follow a certain number of rules, and they actually have four that are very, very critical that they follow every single day. Number one, they want your money, and they understand that, and they're able to target specifically the type of people that they want to go after and the type of money that they want to get. Now, they want your money to come in systematically. So they want you to give them your money either on a daily basis, on a monthly, on a quarterly, on an annual basis, but they want you to give them money every single day possible that you have access to that transaction. Number three, they want to hang on to your money for as long as possible. And then number four, they want to give it back to you at some point in time in the future as little as possible. Now, just take a look, like for instance, for those of you that put money away in IRAs and 401ks, what do you think the institutions that are holding those accounts, what do you think they're doing with your money? Number one, they want you to give it to them. They want you to give it to them consistently. They want to keep it for as long as possible. And then they work in congruent, or they work congruently with the government in order to maximize the impact of you trying to take all your money out at once. So that way you may be forced to start taking the money out little by little every year. So it gives them additional decades of having ownership of your money prior to giving it all back to you at some point in time. What these firms don't want you to do, as you can see there on the last part of the slide, is that they don't want you to use economic straddles and techniques that would create an efficient management of assets for you, for your family, and ultimately your business and your retirement distribution planning. So they're going to try to do the very, very, very best that they can in order to guide you away, you know, from really drilling into how it is they make their money and how it is you can prevent them from trying to get at your money on an ongoing basis. Now, when it comes to each and every American in the United States, you and I and all of us have a personal economy. And you have to understand how your personal economy works, because if you have the ability to understand that, then obviously, foreseeably, you're going to be in a much, much better position in order to manage your assets and that of your family in retirement. Now, I divide the personal economy of each tax-paying American in the United States in three major areas. You have your accumulated wealth, you have your lifestyle wealth, and then you're going to have your transfer wealth. Now, you will find that the vast majority of competitors or companies that try to emulate the type of business that we do, they're going to work with you in the area of accumulated wealth and lifestyle wealth. Most of the firms that you will find out there in the marketplace have no clue how to manage and how to minimize the risk of transferring your wealth to financial institutions and the government on an ongoing basis. And that is one of the major specialties that we bring to the table based on the customized tax planning and retirement blueprint that we do for those clients that are suitable to meet the goals and objectives of what we do as a firm on an ongoing basis. So let's talk a little bit about your accumulated wealth. And that's primarily, you know, all the stuff that you own, as you can see there on the slide. You have your 401ks, you have your IRAs, you have your savings accounts, you have your investments, you have your real estate. You know, any statement wealth that you have, that is what I consider to be accumulated wealth. By the way, when you visit with a financial advisor, usually they're going to have you bring in, you know, all of your statements, all of your investments, and their number one goal is to get you to move those assets with them, because they're going to try to share with you that if you're earning 4, they can get you 5. If you're earning 5, they can earn you 6. Although most of the time, they're not going to be able to do any better than most of the institutions that you may already be working with. So understanding your accumulated statement is very, very critical in understanding your retirement distribution planning and your future plannings as such. So you may be 40, 50 years of age, you may have 15 to 20 years away from retirement, but if you understand how to navigate the accumulated wealth portion of your portfolio and your personal economy, then you're going to be in a much better position than anyone you have ever dealt with or met with before. Now, when it comes to your lifestyle wealth, there's an economics rule called Parkinsons Law. And Parkinsons Law basically says that obviously if you have 20 hours to complete a task, you're going to start completing the task in the 19th hour. You know, we as human beings have a tendency to postpone stuff. We as human beings, also from a financial standpoint, also the more money that we make, the more money that we spend. So the opportunity cost and a lot of the financial decisions that you make in your life is going to play a negative impact in what you're going to be able to do at some point in time in the future. So, you know, the difference between needs and wants. You know, I live in South Florida. I grew up in Boston. In Boston, I didn't need a car because, you know, public transportation was really, really good. If you live in New York City or you live in Chicago, you know, obviously public transportation is very, very good. So you may not need an automobile because of the fact that the public transportation system is apropos and adequate to get you from point A to point B. But there's a difference between needing an automobile and wanting an automobile. So in other words, I need a car, but I don't need a Mercedes. I don't need a BMW. I don't need a Rolls Royce. I don't need a Jag. So understanding the difference between needs and wants are very, very critical if you want to maximize your business and retirement opportunities in the future. Now, obviously, you also have your future wishes and desires, and they go along the same lines as the needs and wants. You have to truly understand that if there's an inflation rate in the United States, and we'll talk about that in the next few minutes, there's also a personal inflation rate. So whether you buy a $60,000 automobile or a $40,000 automobile, they can both take you from point A to point B, C, and D. The question is, you know, how do you want to get there? Now, obviously, there's a $20,000 arbitrage between the $60,000 automobile and the $40,000. The question is, what can you do with that additional $20,000 if you keep it on your side of the ledger? If you keep it on your side of your personal economy, as opposed to transferring that portion of that wealth to the financial institutions, in this case, the car company, in order to have a want as opposed to a need. And then last but not least, obviously, you have your transfer wealth. And the transfer wealth comes under, from an economic standpoint, something that we call Suttons Law. And Suttons Law, I don't know if you guys have heard the story, and this is a true story. Willie Sutton used to be a bank robber back in the 40s and 50s, and he was out in the Midwest. And Willie Sutton was such a bad bank robber that he got caught a few times. And obviously he got caught as a teenager, so, you know, he would be given 2 to 3 years, and then he would come out, do it again, and so forth. But once he became an adult, the rules of engagement totally changed for him. So the last time that he got caught, he was actually being walked by the sheriff to the courthouse, from the jail to the courthouse. And the sheriff basically said to Willie Sutton, he says, you know, Willie, you're really bad at what you do. I mean, you've been caught 3, 4 times already. So if you're always getting caught, you know, why is it that you continue to rob banks? And Willie Sutton said, well, that's where they keep the money. So the analogy to that story is that any time that either the government, a financial institution, or large corporations know where it is that you are keeping your money, they're going to try to get to it in the most efficient way possible for the betterment of themselves and their company. So obviously, you see there some of the reasons why they keep their money, and what are some of the areas where you may have some transferred wealth that occurs on an ongoing basis. Auto financing. Auto financing happens to be one of the biggest ones. And I hear this all the time. Bert, you know, I just bought a car at a 0% finance, and I'm going to be able to finance for, you know, 3 or 4 years. There is no such a thing as 0% financing, because 0% financing means that the financing cost has already been added on to the price of the automobile. And the reason for that is very simple. The vast majority of our car companies and manufacturing companies, they make the money on financing. They have to stay very competitive. So from a pricing on the automobile standpoint, they're all pretty close to one another, obviously depending on the type of automobile that you're acquiring. But for the most part, where they truly make their money is in the financing of these vehicles. So no financial institution is going to lend you money for 3 or 4 years at no cost whatsoever. Obviously, mortgage financing and the points that you're paying and the interest rate that you're paying and how long you're paying that interest rate for, you know, that's another way where wealth is being transferred from your personal economy to that of the institution that you're doing business with. Taxes and fees, and this is one that I talk about to my clients all the time. You know, if you're getting tax refunds every year, there's obviously a tremendous cost on that. And then the vast majority of the clients that I engage for the first time, they're actually paying more in taxes than they need to. Interest volume. You know, it's not about the interest rate. It's not about the annual percentage rate or the APR rate. It's actually the volume of interest of all the accounts that you're paying interest, and that money is being transferred out of your personal economy to other institutions. And then obviously, last but not least, opportunity cost. So those are things, obviously, that whenever we do a tax planning and retirement blueprint for our clients, we pay a lot of attention to, because our number one goal is to minimize the transfer of wealth from yourself to an institution. Think of it this way. If I can reduce your transfer of wealth by 10, 15, 20, 25, 30% every single year, that is more money that's staying on your side of the ledger that is not going somewhere else, you know, for the rest of your life, and that we can recapture and reinvest in other areas that are going to be very, very critical for the vast majority of Americans. Now, what are the challenges of income that we have here in the U.S.? Well, taxes alone are going to take anywhere between 40 to 50 cents out of every dollar that you earn. So 40 to 50% of your income is going to go to taxes. Now you're going to say to me, Bert, you know, I don't pay 40 to 50% in taxes. Well, the reason why you may be saying that, and you'll see that in the next couple of slides, is that most Americans, when they think about taxes, they're only thinking about federal income taxes. They're not thinking about all the array of all the other taxes that are actually hitting you every single day, and many of them you don't even know about. Debt is going to take anywhere between 30 and 40% to factor in your mortgages, your automobile expenses, your auto financing, your credit card debt. All of those numbers are going to be anywhere between 30 and 40%. And then obviously lifestyle wealth, which is the one that we talked about earlier, is going to take anywhere between 20 to 30%. And then last but not least, savings is going to be anywhere between 0 to 10%. There have been periods in the United States, at least in the last 10 to 15 years, where the savings rate for most Americans was actually in a negative. So that's something to critically understand. Now, when you're in your 20s and 30s and maybe in your early 40s, your savings rate may be anywhere between 0, 3 to 5%. Only when you get into your 50s and 60s or late 40s, for some of you, is when you start thinking about the fact that you don't have that many more years before retirement, so you start accelerating your savings program. But when you average the savings percentage in your lifetime based on the amount of income that you have the ability of earning, you're going to realize that for the vast majority of Americans, you know, most of us are only saving approximately 3% of our income on an ongoing basis, on an annual basis as well. Now, along those lines, I think it's very critical to understand and very important to note that there are 10 major wealth eroding factors that I discuss with my clients and I bring to light every time that we engage clients in our planning and blueprint, tax blueprint process. And as you can see there are 10 of them. Now, obviously, I'm not going to cover all 10 of them for this call today, but you have taxes, inflation, stock market volatility, interest rate volatility, lost opportunity costs, like, you know, the exercise I walked you through with the arbitrage between the $60,000 automobile and the $40,000, financial expenses that all of us pay, loans and interest charges of financial institutions and major corporations are charging you every year. Technological changes, you know, things are changing every single day of the week in this country. And somehow we're always looking for that newer and brand new gadget. When Apple comes out with a brand new iPhone, you have people spending 2 days in line, sleeping in the middle of the street, you know, lining up to get the iPhone that is brand new that's coming out. So there are always technological changes in our country that we want to have access to. So we got to be careful about that. Obviously, wear and tear. You know, things break up all the time. So if you own a home, obviously your roof has to be replaced or repaired. Obviously, refrigerators, microwaves, furniture, and automobiles, and so forth need to be attended to. And then, last but not least, lawsuits. We do live in a litigious society, so in our country, you can pretty much sue a ham sandwich. But by the same token, these are the 10 major eroding factors that you need to deal with. So whenever we do any type of planning, we want to make certain that we can reduce our clients' exposure to the eroding factors, because if I can reduce your tax liability and your inflation liability through personal economic decisions, and also if I can reduce and eliminate any type of stock market volatility when it comes to your retirement assets, then I can actually put you in a much, much better position than you were before you came to visit with me. And by the way, this takes no risk whatsoever. So you can retain more of your money. You're able to guarantee more of your assets in retirement without having to take any type of risk whatsoever, which is not something that Wall Street would want you to exercise and or know anything about. Now, I always like to share with my clients as well, you know, what are the certain principles of economics. And the first principle of economics that I share with all of you whenever we engage each other, or in the times that we have had these workshops in the past. By the way, if you follow my podcast, I have already done 66 podcasts, almost 2 years of great information, but most important, education. And I also have a YouTube channel and a Vimeo channel. So if you're interested at the very end, if this is your first time joining us, feel free to reach out to me and I'll make those available to you, because you're going to be privy to a tremendous amount of information that only our existing clients have access to. So the first principle of finance that I want to share with all of you is that in this country, everything is financed. Either you're paying interest to someone else, or you're failing to receive interest on your money by paying cash. And this is what I get all the time. Bert, you know, I don't finance anything. I pay cash for every single thing that I do. As a matter of fact, I just went and bought a $40,000 car. I paid cash for it. Well, from an economics perspective and from an economic standpoint, everything that you do is finance. Either you're paying interest to someone else when you finance that automobile through the car company or the dealership, or you fail to receive interest on your money when you pay cash. So if you write a check out of your savings account, or you transfer money from your savings account to your checking account, and then you write a check for, you know, $40,000 to that car company, not only have you lost those $40,000, and yes, I know you need an automobile, but you also lose the opportunity cost that those $40,000 could have been earning on your behalf had you left the money inside that savings account, or CD, or mutual fund account, or investment account. Now, you know, the one decision that you have to make is, when does it make sense to finance versus paying cash? Well, it depends on the interest rate arbitrage. So if you're earning 6-7% on your money, and it's costing you 3% to buy an automobile, then you may be better off financing that transaction through the car company, because there's an arbitrage between the money that you're bringing in on an annual basis on the earnings on that investment versus what you're paying out to the car company. You're bringing in 6%, 5, 6, 7% interest. You're paying out 3%, 2%. Then obviously you're still on the positive side of that equation. If it was the other way around, then it may be more suitable to pay cash for that vehicle. And then obviously you just got to figure out if there's going to be an opportunity cost and how to reduce it as much as you possibly can. At the end of the day, when you're using debt, you're pretty much borrowing from your future earnings. And obviously, when you pay cash, you're borrowing from your past savings. So if you can have a clear understanding that everything in this country is financed, and for many of you, this is the first time that you have heard this. And by the way, if you haven't heard this from your other financial advisors, then you should be questioning yourself as to why you want to work with financial advisors that are not trying to educate you on the principles of economics that are going to be so prevalent for you in the future. Now, where do wealth transfers occur? As we talked about, as you can see it there, taxes. You know, the vast majority of my clients are paying more in taxes than they need to before they come to see me. And the reason for that is that there are 3 taxable buckets, and obviously we'll talk about that in the next couple of minutes, but they're paying a lot more in taxes than they need to. So if I'm able to recapture that, then we can put them in a much better position. Tax refunds. You know, a number of my clients say, you know, I love to get a tax refund at the end of the year, and my question is, why? You know, why would you want to get a tax refund? Basically, what you have done when you get a tax refund, you have given the IRS an interest-free loan for an entire year, sometimes even 14, 15 months, depending on when it is that you file your taxes. So every time that you take a tax refund, that means that you gave the IRS an interest-free loan. By the way, when you owe them money, they charge you interest. When they owe you money, they don't pay you with interest. So that's something to consider. Obviously, credit cards, auto financing, mortgages, retirement plans. You know, obviously there's a major liability along those lines that we'll talk about. Now, whenever we do any type of tax planning and financial blueprint, because of the fact that the vast majority of my clients have always made financial decisions through a microscope as opposed to a telescope, here's how they look at their world. Okay, so they're making $100,000 a year. They're servicing their debt, their mortgages, or credit cards, or automobile financing, and so forth. So they're spending anywhere between 30 to 35%. On the average, it's about 34.5 cents out of every dollar is going toward servicing the debt for most Americans. So that means you're earning $100,000. You have $34,500 that you're paying out to financial institutions and major corporations along those lines in order to pay for those services that you're acquiring, and you're okay. You're living with that. You're living day by day. As a matter of fact, for the vast majority of Americans, you don't even know what percentage of your income is actually going to debt servicing. But what you do feel very comfortable about and very happy about, that if you have a $150,000 401k sitting at a financial institution and you're making a 10% on an annual basis, and I'm being a little bit fictitious there just to give you a rounded number and a number that is fairly easy from a math perspective, then on 150,000, 10%, you're earning 15,000. So you're very happy of the fact that you're earning $100,000 in either in your business or in your career or in your job. And on top of that, you're earning $15,000 a year as a rate of return on your investment. So you are very happy. From my perspective, you're taking one step forward and 2 steps back. because from an economic standpoint, when you look at your financial world through a telescope as opposed to a microscope, here's what you see. You're sending out of your personal economy $34,500, and then you're gaining, or you're adding to your personal economy $15,000 through the rate of return on your 401ks or IRAs or any type of savings. You still have a negative rate of return for the year of $19,500, or a 19.5% negative rate of return. And that's my definition of moving one step forward and two steps back. So if I'm able to reduce the transferring of your wealth through rearranging the chairs on the Titanic, because otherwise you are the Titanic and you're going to be sinking to the bottom of the ocean. But if we can financially plug the holes in your finances, then obviously you're going to be in a much better position. You're going to be able to offset that arbitrage and be able to do better for yourself and your family along those lines. Remember that I said that most of you are paying anywhere between 40 to 50% in taxes? Well, check it out. See, what most of us don't realize is it's not only the fact that you're paying federal income taxes, you're paying Social Security taxes, Social Security income tax if you're already retired, Medicare tax, state income tax if you happen to be in a state that pays state income taxes, property taxes, personal property taxes, school taxes, cell phone taxes. I mean, you have all of the taxes, every single bill that you get, electric bills have all kinds of fees and surcharges and taxes that you pay. Now, financial institutions and major corporations have become very, very smart in how it is that they disguise all of these taxes. They may call it surcharges, they may call it fees, but it's nothing more and nothing less than a perpetual approach to trying to get at your money through different ways and means that they have become experts in doing so. Now, let's talk a little bit about the anatomy of taxation. This is, again, something that we educate all of our clients on because it's important to understand. Now, most clients understand compounding. Most clients understand that, you know, you want a compounding effect. So if I were to ask you on this call, would you rather have compound interest or simple interest? Unless you're totally oblivious to finances, you're going to say, Bert, I would rather have compound interest than simple interest. And you would be correct. By the same token, if I ask you if you would want to have compound tax instead of simple tax, all of you would say, nope, we would want to have simple tax. The problem is that unless you do proper tax planning, you cannot have or accomplish a compound interest with simple tax. And the reason for that is obviously most of you are compounding their taxes. And you're doing this every day in your investments, in your 401ks, in your IRAs. You're doing that every single day. Now, you also have the ability not only to compound your tax, you also have the ability to net it. So let's say you have an investment account, you have a mutual fund, and the mutual fund account gave you a 6% rate of return for the year. Obviously, you're in the 30% tax bracket. So if you have $100,000, you made $6,000. $1,800 is going to have to be paid. Now, instead of allowing those $1,800 in that account to be compounding and paying the taxes out of another account that you may have, you do have the ability to do netting, which means that you actually take the $1,800 out of that account and then pay the taxes from that account. So you're actually netting the taxes from the actual account that earned that 6% on your behalf. The other thing that you can do there is you can do flattening. That means that and the difference, and that is one of the beauties of understanding taxation, because if you have the same $100,000 in an account earning 6% or $6,000 a year, and then obviously you want to do flattening, what you're going to do is instead of allowing that $6,000 to continue to grow in that account, you would pull that $6,000 out. Obviously, you would pay the $1,800 that you would have there. And then the difference you're going to invest into a tax-free account that would now earn money on your behalf on a tax-free basis for the rest of your life. So it gives you the ability to do a straddle, to do economic straddles, in which you're going to be able to position yourself in a way that you're only going to pay taxes on your money once, and not having that compounding effect also on the compounding tax as well. And then the pay down is where you say, well, if I have a $100,000 mutual fund and I want to pay it down over the next 10 years and it's earning on an average 6%, how much money do I need to take out every year out of my principal and interest to make certain that at the end of 10 years, I have no money left in that account and all the money has gone to a tax-free account that can then grow tax-free for the rest of my life. Now, obviously, understanding the compounding effect of those things are going to be very critical for you and your family in retirement as well. Understanding qualified plans, and we're getting closer to the end of this webinar. Obviously, taxes are not saved. They're actually either postponed or borrowed. So when you're putting money away, and by the way, I do tax planning and I do accounting, so I have arguments with accountants all the time, because they're always telling their clients, you know, you need to put money in a 401k and an IRA because you're going to be saving money on taxes. You're not going to save any taxes. All you're doing is postponing the tax. And when you postpone the tax, you also postpone the tax liability. So it's critical that you understand that as well. Qualified plans are controlled by the IRS. Obviously, you have distribution penalties. So if you're in an IRA or in a qualified plan and you need to take straight out distributions, you're going to have to deal with the 59.5 rule and the 70.5 rule. 59.5 rule basically says that if you take money out prior to age 59.5, you're going to have to pay a 10% penalty unless you meet certain exigent circumstances that are not easy to meet. And then the 70.5 rule basically means that at the age of 70.5, whether you have a need for your money or not, if you have money in those accounts, you need to start taking money out whether you want to or not, because otherwise you're going to have to pay a 50%, yes, you heard me right, a 50% excise tax penalty on those distributions that you needed to take, but you failed to take at that point in time. So always remember that when it comes to your IRA and your qualified plan assets, like your 403Bs and your 401Ks, you only have control of your money for an 11-year period, between 59.5 and 70.5. Before that time, there are penalties. Post 70.5, there are also penalties unless you do it the right way. Now, the IRS is going to determine liability in the future. So, you know, when you're postponing the tax by putting money into a qualified plan account like an IRA or 401k today, you're also postponing the tax liability. And unless you know where taxes are going to be in the next 10, 15, 20 years in the future, you're never going to know what percentage of the assets that you have in those accounts actually belong today, and when you belong to you. And when you take a look at where we're at from a debt in this country, and the fact that that debt will continue to spiral out of control, there's a very high probability that over the next 10, 15, 20 years, taxes are going to have to double, or our country is going to go bankrupt. So that means that instead of having to pay the tax today under the new tax law, you may be forcing yourself to pay the taxes with a 30, 40, 50%, maybe even 100% increase at some point in time in the future. There are no deductions in qualified plans for investment losses. So in 2008, when your 401k became a 201k and you wanted to take money out, you couldn't take a tax deduction at that time. Distributions are taxed as ordinary income, as opposed to capital gains that actually receive a much better positioning from a taxable standpoint. What else? Tax volume will actually increase 8 to 12 times during your retirement years on the assets that you're pulling out of these accounts because of the compounding of the tax that took place while you were making contributions to these accounts for all those years. Lack of flexibility and distribution control is very critical. If you happen to borrow from a 401k, you have to repay those funds within 5 years. And when you repay the fund, you repay those funds with after-tax dollars. So that way, when you pull the money out again in retirement, you're going to have to pay taxes on those repatriated dollars that you put there after tax. You're going to have to pay taxes on those dollars again. So there's a double taxation issue and concern along those lines. Now, when it comes to retirement distribution planning from an economics perspective, you have to think of it this way. And this is something that we have done very, very well for years in our firm. And when it comes to retirement planning, you got to think about preparing for 3 decades of distribution. So you have what I call the go-go years, the slow-go years, and the no-go years. The go-go years, if you retire at the age of 65, is between 65 and 75, more or less. Depending on your health. You know, you're still healthy, you're traveling, you know, you want to visit places in the world that you didn't have the ability to do so before because you were too busy, you know, working, making money and saving money. You know, once you hit your mid-70s to about 85, between 75 and 85, you go into what I call the slow-go years. Your health may not be as good as it used to be. You may not be traveling as much. You may want to stay closer to your family and your children and your grandchildren. And then once you get into your mid-80s until that point in time in which you die, then you go from the slow-go years to the no-go years. You're not going to be doing much. Your health is obviously not going to be the same as it was in your go-go years and the slow-go years. Your number one goal when you're in the no-go years is to try to wake up on the green side of the grass every day and as healthy as you possibly can. So exercising and dieting and taking care of yourself from a medical standpoint is going to play a major role along those lines. Now, as you all may be aware, money is taxed in 4 different ways, and you see there are 4 boxes. I'm going to start real quick from the ones on the top left. So you have tax, and tax. You know, that is what we call the taxable bucket. That taxable bucket, that means the money going in is after tax. The money is taxed every year through 1099, so you get from the financial institution. And then when you sell your investments inside that bucket, they're also going to be taxed. And what's going to fit there? Well, primarily your savings, your CDs, your traditional mutual funds, and so forth. So you got to be very careful along those lines. Although from a taxable standpoint, it's not a very good bucket. From a liquidity standpoint, it's excellent bucket to have. And for that reason, you need to have the optimum. You cannot have too much money in the taxable bucket, which is something that we find with every client that we engage for the first time. But you need to have the optimum amount of money in that in the taxable bucket in order for you to maximize the efficiency of that bucket, maximize the precipitation and also the ability to have access to your money, but also minimize the tax liability. Then the next 2 buckets in the bottom, the tax, deferred, and tax bucket are primarily, and then your deferred, and tax. Those 2 buckets right there would be your tax deferred bucket. On the left-hand side on the bottom, you have the tax, deferred, and tax bucket. Primarily, those are your annuities where you put the money in. The money obviously grows tax deferred, but if you pull the money out prior to age 59 and a half, obviously you'll have to pay a penalty there. Anytime that the IRS gives you the ability to defer taxes, they're going to place certain rules. So in this bucket, you have the 59 and a half rule because you have 1 deferment there. Obviously, real estate, although there's no liability there on real estate, but you do have the 1031 exchanges that you have to deal with, non-qualified IRAs, and so forth. Now, the next bucket to the right is deferred, and tax. And that's a bucket that the vast majority of Americans are putting money in. Those are your qualified plans. So your IRAs, your 401ks, your 403bs, as you can see there, the money going in is pre-tax. The money grows tax deferred, and then when you pull the money out completely, is totally tax-free. So obviously, the challenge there is you're deferring the tax and you're also deferring the tax liability. Because you're deferring not only the contributions but also the growth, then the IRS places not only the 59 and a half rule on that bucket, but they also place the 70.5 rule that you need to be careful with. Now, the last bucket is a top right bucket that you see there, and that's a tax deferred and tax-free bucket. And those are the buckets, that is the bucket that is the most important bucket in the IRS code and the least understood. By the way, the vast majority of the clients that I engage for the first time, the majority of the money is either in the taxable bucket or the tax deferred bucket, or a combination of the two. Very few of my clients have money in the tax-free bucket. So the tax-free bucket is comprised of your Roth IRAs, your Roth 401ks, and your 7702 plans that are cash value life insurance plans that enjoy some of the best benefits under the IRS code. And then on top of that, you have municipal bonds as well. Now, out of those 4 buckets that I just covered for you, there are actually 3 tax preferred buckets, and those will come, you know, from the taxable, the tax deferred, and the tax-free bucket. Notice that the tax deferred bucket, I took the bottom 2 buckets in the previous slide and I put them together to make it easier for you to understand from a business standpoint. You know, one of the questions in understanding how taxes work, and a lot of the work that we do with our clients is tax planning, is the fact that we always want to get them to understand that if you're able to reduce your tax liability, it takes no risk whatsoever, and you're keeping more and more of your money on your side of the ledger. The feedback that I get from some of the clients is, well, Bert, you know, why should I maximize my contribution to the tax deferred buckets if I'm going to be in a lower tax bracket in retirement? And the answer for that is that unless you happen to be a financial failure, a complete financial failure on your life, the probability that you're going to be in a lower tax bracket in retirement is going to be slim to none. Why is that? Number one, the vast majority of deductions that you have prior to retirement, you're going to lose in retirement. So your mortgage interest, obviously, if you paid your home along those lines. Some of the other ones that you see there, let me put on my glasses so I can see a little bit better. Your kids, you know, you're hoping that your kids are going to be out of the house, but even if they're not out of the house, by the time you retire, you can no longer claim them. Qualified plan contributions, you're no longer making contributions to qualified plans. And then last but not least, in retirement, you know, prior to retirement, you're making contributions to charitable organizations, but in retirement, you're going to start shifting those contributions from making money contributions to giving your time. And the IRS does not give you any deductions for your time. So because of the fact that you're losing a lot of those deductions that you had prior to retirement, you may actually find yourself in the same tax bracket in retirement that you were while you were employed or not in retirement, and sometimes even in a higher tax bracket, even before the government does anything that they think about doing in the future. Obviously, the tax-free sources in retirement, as we have discussed briefly, your Roth IRAs, your Roth 401ks, your municipal bonds, and your 7702 plans. Out of the 4, I take municipal bonds out of the equation because although municipal bonds are federal income tax-free, they do create a problem when it comes to your provisional income calculation in retirement, and the distribution out of your municipal bond funds can actually have a negative impact on the taxation of your Social Security benefits, and most important, on the increase in your Medicare premium in retirement. So out of those, the only 3 that are true preferred retirement sources where there is no federal income tax, no state income tax, no Social Security tax, no capital gains tax, and no negative impact on Medicare premium would be your Roth IRAs, your Roth 401ks, and your 7702 plans. Now, not everybody can put money in a Roth 401k or a Roth IRA. If you don't have earned income, you can't contribute to those. If you make too much money, you cannot contribute to a Roth IRA. So you have to understand what the balance is, because if you want to create a tax-free retirement life for yourself and your family in the future, that it is critical to understand how the rules of engagement play and what you need to do in order to create advantage and opportunities for yourself, your family, and your business in the future. Now, obviously, what are some of the longevity risks that we need to deal with? Well, living too long, living with a disability, and living with eroding factors. Living too long is a big issue in the United States. Yeah, people want to live longer, but because of the fact that people are living a lot longer today, it doesn't mean that that they're going to be any healthier in retirement. So the mortality today for living long, if you happen to be a healthy couple age 65 year today, there's a 50% chance that both of you are going to be alive at age 85, and there's going to be a 25% chance that one of you is going to be alive at age 92. Usually that person is going to be the female. Women have a tendency to live longer than men. So again, you have to plan for 3 decades. Remember the go-go years, the slow-go years, and the no-go years. You better be able to be planning for 3 years of retirement distribution planning. By the same token, people are going to run out of income before they run out of life. Most Americans will. 97% of Americans are going to run out of income, and they're going to run out of money before they run out of life. Taxes and inflation are going to devastate retirement distribution planning because obviously it's the compounding effect of those taxes and inflation that are going to eat away at every single dollar that you earn. And most retirees will only have Social Security benefits in retirement, especially when they get into the slow-go years and the no-go years, and that's very, very sad. Now, because of the fact that people are living a lot longer today, people have more susceptibility to experiencing disabilities and long-term care needs in the future. So 75% probability of a long-term care need in retirement for 65-year-old American couples. So if you are 65 years old today and you're healthy, there's a 75% probability that one of you is going to have a need for long-term care in the future. The cost of nursing facility and nursing homes in Florida today is approximately $92,000. Over the next 20 years, it's going to be approximately $295,000. That's inflation cost on long-term care and nursing facilities. And the big issue is what's going to be the impact to family and care providers alike. Obviously, Medicare does not cover long-term care. So if you find yourself that, in a married filing jointly couple, one of them has a need for long-term care, you may actually be destroying that survivor benefit for a surviving spouse because there may not be any money left. Because in order for you to qualify and anyone in your family to qualify for Medicaid, you have to go into what is known as Medicaid spend down rules. I'm not going to cover them all, but you have asset and income cap dilemmas that you need to deal with. You have to use spend down techniques. Most of them have to be in place for at least 5 years. So you're going to have to spend down all of your assets. And when you do so, what's going to be left for your surviving spouse? So doing proper planning that would protect you from the risk of living with a disability is very critical in retirement. Now, living with eroding factors, obviously, taxation is going to decimate 40% of all your income in retirement unless you do proper planning. And it's going to get worse because taxes are going to have to increase in the future because we have the highest debt in the history of the United States, and then we're actually living in historical low tax rates today. Inflation management. Inflation can take away 65% of your purchasing power in just 20 years in retirement. So you need to be able to find ways to stay ahead of inflation. Market and interest rate volatility can actually deprive you of having a successful retirement plan. And if you compound all of those taxes, inflation, and stock market volatility and interest rate volatility, it can decimate all of your assets very, very quickly. So you need to do proper planning along those lines. And you got to be able to plan, for those issues that are very, very critical, which is how do you manage the risk of living too long, the risk of living with a disability, the risk of living with eroding factors, factors like taxes, inflation, volatility, and so forth. And then last but not least, the risk of dying too soon. So we're coming to the very end of this short webcast. And for those of you that are joining us for the first time, I think the big question to all of you is, if you are excited about the stuff that you have heard today, if you can walk away with one idea that I have given you that you had not heard before, and you want to learn more, you want to get additional information, then the one question I ask of you is, how would you like to be able to work with us and put together a customized tax planning blueprint that can assist you in maximizing your benefits while reducing all of those liabilities that we have discussed. Obviously, I would love for you to schedule a call with me today, either a video conference or a traditional call. The first call would be primarily a meet and greet. It's basically I'm gonna be listening to everything that you're talking, everything that you want to discuss. What's keeping you awake at night from a financial business perspective. What will you learn that is new? Obviously, you're going to be learning a lot of stuff because I just hovered over some of the things that are very critical, but there are others that may be applicable and apropos to your personal situation. How long will it take? It takes usually 30 to 45 minutes in the first meeting that we host. What should I bring or have available? Absolutely nothing. This is a meeting where it's going to be a meet and greet. We're going to be talking to each other, usually in the same way that I'm talking to you today, except that instead of doing it for the masses, it would be between the two of us. Will I try to sell you anything? Absolutely not. I don't even know you, don't know anything about, what keeps you awake at night. So there's not going to be a conversation along those lines. How will I feel when it's over? I think you're going to be very excited. Where will we do it? Well, we could do it in person. We could do it over the phone. We can do it over a video conference. The vast majority of my clients today are doing it over a video conference from the comfort of their home or their office. What will the next steps be? Actually depends. I have no idea whether the customized tax planning blueprint that we put together for our clients may be suitable to you. And you also have to decipher for yourself whether our firm may be suitable for you as well. So there's no force there. There's no pressure whatsoever. We're limited as to the number of clients that we take every year. So we want to be very candid along those lines. I'm going to be asking you 4 questions. What plans have you done to triple your income in retirement? Because if you haven't done any, you better, because you're going to need to. What would happen to your financial situation if the market dropped 45% tomorrow like it did in 2008 and 2003, and now you're in retirement? What would you have done, and what would you do as a family in order to protect, and what have you done to protect yourself and your family and your retirement assets from stock market volatility? And then last but not least, what plans have you and your family done to protect against the risk of living with a disability like long-term care, Alzheimer's, Parkinson's, stroke, and all those things? So those are questions that we're going to be discussing, but I'm going to be listening to you for the vast majority of the time. Obviously, there's a lot to look forward to. You'll have a chance to talk. You will learn some ideas. You're going to have the opportunity to engage us personally. You're going to get something of value. And something that is very valuable, because when you walk away, whether we decide to move forward or not, I'm going to give you a white paper, which is one of the best white papers in the industry dealing in how to create a tax-free retirement life for yourself, your family, and your business. You're going to gain a tremendous and positive experience of just having a short conversation with us. And then obviously, it's very easy to do. So the definition of insanity is doing the same thing over and over again and expecting a different result. So, even if you say, I don't have my calendar, just schedule a meeting. We can always change it at some point in time. I want to think about everything everybody else does, but at the end of the day, life gets in the way. So tomorrow, the next day, 3 days down the line, you're going to remember very little of what we have covered today. If you already have an advisor, it doesn't matter. have access to our information, obviously at least you would have the ability to, convey some of this information to your advisor. And by the way, if you have an advisor and that advisor has not talked to you about some of the things that I have described here today, then you should be questioning that relationship moving forward. By the way, if this package, all it did was to increase your income between 35 and 50% every single year, if all it did was to reduce and or eliminate your taxes in retirement, and all it did was to create guaranteed income for life that you and your family cannot outlive, and if all it did was to protect your family from the fatal four, the risk of living too long, dying too soon, living with a disability, and living with eroding factors. If you're able to do that through a tax-preferred retirement blueprint, how would you feel about something like that being done to you? By the way, the type of work that we do when we create these packages for our clients is at no cost or obligation. We want to have the ability to earn your credibility and trust before you decide to move forward with us. Now, why we shouldn't work together? Because I'll be straightforward with you. Well, if you're satisfied with your taxes and your tax rate, if you have a CPA or accountant that does tax forward planning, most of them don't have the ability to do, but if you do, then there's no need for us to move forward. If you already have a fail-safe retirement plan, if I'm more interested in your financial success than you are, remember the difference and the analogy about being involved or being committed with the bacon and eggs for breakfast, or if you have a family member that happens to be in the business. Now, why we should work together? Well, if you want to minimize your taxes and maximize your Social Security benefits, if you want to create a fail-safe retirement plan, if you want us to audit all of the planning that you may have already done for your retirement, obviously that's a major reason as to why we should be able to work together. If you want to create a comprehensive retirement blueprint, and if you're actually concerned about your retirement affairs. So my call to action to all of you today is to, give us a call. Get on a conference call with us, 30 to 45 minutes. If we need to go a little longer because you have more issues, then no worries. There's no charge for that call. Let's schedule a 30-minute video conference at no cost or obligation. You can actually go to my calendar there, but it would be much easier to just give us a call at area code 786-766-1042. Again, area code 786-766-1042. You can also email me at Bert, B-E-R-T, at GablesTaxGroup.com, or you can visit our website, our www.gablestpg.com. And obviously, I want to thank you for giving us a little bit of time today, and thank you for your support, because many of you join us on these educational workshops that we do the third Thursday of every single month. And let me go ahead and stop sharing and say goodbye to all of you. So at the end of the day, whenever I finish one of these, it's important for me to share with you that the reason why we do this and the reason why we take the time to provide this education with you today, although I happen to be out of town today on Valentine's week, is that my number one goal and that of my firm is to help you and your family change the way that you do things. Because when you change the way that you do things, the things that you do change. So again, thanks very much. Happy Valentine's week. Hopefully you enjoy your weekend, and we'll see you again next month. Take care and have a great day. Bye-bye.